Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back for another Wall Street from Main Street podcast interview. Today's special guest is a returning guest and one of my favorite guests. He's a former vice president of Sprott. He has decades of experience in the commodities industry, both as a credit analyst and also financing hundreds of different mines. He's invested and traded many different commodities over the years as a contrarian value investor. Rick Roll, thank you for joining me again.
Pleasure, Jason. Thank you for having me back.
Very exciting times, Rick, too. Finally, we're starting to get some moves now in the gold and silver prices. I don't know if we've seen these types of moves before over the last 12 months. Seems like there's a new demand driver coming from retail demand in Asia.
I'm not sure about Asian retail demand because it's very tough to quantify. What is easier to quantify is that the early part of the move in gold this year and last year was really central bank buying. ETF flows show that at least Western retail investors weren't involved in the market at all until about 20 weeks ago, except as net sellers. One who is long gold would hope that in the future demand is driven both by the central banks and by retail buying. Time will tell, of course, if that comes to pass.
Exactly. And to add to your points there, one of the best sources of publicly available information is the wholesaler retail. They also own online retail bullion dealer A-Mark, and they've been saying that sales are trending down. So that's the best source of information for U.S. Retail bullion sales, and their sales are trending down.
Right. And A-Mark is, of course, the largest retail wholesaler in the country.
I think they've been consolidating too with like the mints and refiners. They may end up owning a near monopoly in the next 5 to 10 years. So we're recording this interview on Wednesday, October 23rd, 2024. The gold price is down a little bit at $2,715, give or take. The silver price is still above $33 at $33.67. Rick, I want to ask you about profit margins and free cash flow. You've been in many different cycles for these gold miners and silver miners. Have you seen before where these gold miners have had, say, $800 to $1,200 an ounce profit margins and free cash flow? Have you seen this before in the cycle in your career?
I think you need to look back and you need to talk about free cash flows as a percentage of the selling price of the commodity. It would have been tough to have quantum free cash flow margins of that type when the gold price was $500. But there were certainly companies when there was $500 gold that were enjoying $300 cash margins or margins in excess of 50% of the selling price of the product. The margins that we're seeing now in the early part of this market cycle seem better than the margins that we saw in 1999, 2000, 2001, 2002, the beginning of the last cycle. I suppose, and I can only suppose, that that's the case because in the 1990s, the extreme low gold prices necessitated for some companies high grading. Producing material where the mined grade was substantially higher than the median reserve grade, which meant that when they were able to increase production and the price went up, that the material they were moving had less gold, but had higher production costs. Of course, today's release by Newmont was pretty disappointing. There was yet another quarterly earnings miss, which I think probably in the very near term reduces sentiment around the equities of the majors. If you contrast that with the release, 3 or 4 weeks ago from Lundin Gold, where they absolutely obliterated guidance to the upside. They killed their own guidance, never mind Wall Street's guidance. I think what you're seeing now is some mixed results. And if I might speculate, Jason, I think one thing that you are seeing is that the costs which are containable, which are within the control of the mining companies, are being relatively well controlled today. Energy price escalations in the last 6 months have moderated. Labor price escalations have moderated. The input which doesn't seem to have been moderated is the social cost, which is to say off-site concession expense, social concession expense, taxes, and royalties. But the containable costs, the industry seems to be doing a relatively good job of. I think everybody is looking forward to the next Agnico Eagle release. so that we can see what's happening in the quarterlies with regards to best practices miners.
So in past cycles, Rick, when miners tend to get increasing amounts of free cash flow, where do they tend to spend that free cash flow or reinvest it?
Well, it depends. In the 2000 cycle, Wall Street asked the mining companies to exhibit unit growth. And so they spent the money on putting what turned out to be marginal assets into production and engaging in M&A after the early period of that return, where they simply paid down debt. The balance sheets this time are in pretty good shape, and there isn't the same necessity to pay down debt that accompanied the last bull market. I think what you'll see for at least the next 2 years is a continued emphasis, reinforced by institutional investors, to return some of that free cash to shareholders. Certainly, no, that's under discussion at the board level in Agnico, where their balance sheet is in good shape, where many of their major construction expenditures are behind them, and where the free cash is adequate to both make sustaining capital investments, new project investments, and return capital to shareholders. I don't think that you're going to see a demand for institutional, or rather, I don't think that you're going to see a cessation of demand from institutional shareholders for financial discipline for at least 12 months, which is to say, I suggest that increased margins will, in the very near term, be spent either improving balance sheets, which are already in pretty good shape, or increasing returns to shareholders. The institutional investors don't trust the miners yet.
I think we're also seeing some of these miners sell low-cost ones like Lundin Gold and Alamos Gold. They're reinvesting that free cash flow into exploration drill programs like brownfields, maybe a little bit of greenfield projects, and then some of the delayed projects that they had, like mill expansions that were planned maybe a couple years ago, and they were waiting for higher metals prices. I think we're going to start to see those projects invested in soon.
I think that you'll see that in earnest, but I don't think you'll see it in earnest in 2024. The institutional investors, I think, are saying once bit, twice shy. I think they'll let the companies keep the cash on the balance sheet, but I think that you're going to need to see a period of high gold prices last longer for the institutional investors to trust most management teams to invest. I think that circumstance is very different with Lundin Gold, given the fact that the Lundin family controls over 25% of the company. They can say to the investment community, we're using our own money, folks. That's a very different circumstance than companies where, officers, managers, and directors own, 1 or 2% of the company. The Lundins have a special privilege given their large ownership. And I would argue that Alamos probably does too, given that the founder, John McCloskey, is still the CEO. He can point to his investment discipline and financial discipline over the last 10 years and ask for dispensation over the tighter leash that some other companies will operate under.
That's interesting. So you think then that the mill expansions will continue to be delayed? Because I know there are some really good mill expansion projects like Greenstone, for example. It's not fully at 100% production capacity. I think it's around 80%, but they have another mill expansion planned, I think, a couple of years from now to continue to expand the mill. And there's a lot of exploration upside there once they spend it on drilling.
I think in the case of Greenstone, that they're going to have to reach nameplate capacity of their mill before the market lets them be too aggressive with capital expenditure. I'll just leave it there. I think that people are going to want to see them do what they said they were going to do before they're allowed to do something else.
Well, yeah, the timing the timing for Equinox Gold to get 100% of Greenstone was bad. So because their balance sheet was already stretched, as you've said in previous interviews. So for them to go get the 100%, I mean, they had to really stretch their balance sheet thin. So they need to focus on repairing their balance sheet first and getting up to 100% production capacity and getting that mine at free cash flow generation really well first.
Absolutely. I'm still bullish on their ability to do that. I've known those people for a very long time. But they do need to show the market that they can get that done without any more equity dilution. That last financing surprised a lot of folks.
Well, we're almost there, right? So like 80% production capacity, hopefully another month or two.
We'll see. That's certainly their guidance.
Well, they're
They
a couple months in all fairness, I think they're a couple months behind. I think they're 2 or 3 months behind because I think they're saying end of June, I think was initially where they were planning to be at this. Now we are here towards the end of October, so they're a couple months behind.
Yep, time will tell.
I want to ask you now about the juniors. Are we starting to see the juniors raise a lot of funds for, say, 20 million, 50 million for exploration drill programs, or do you think we're not there yet in the cycle?
Oh, we're absolutely there. People who are trusted by the market can raise a lot of money. When people say they can't raise money, they need to emphasize the word they. There's a lot of money available for the junior sector, and there has been for a couple of years. Most of the financings that I've tried to get in for the last 2 years have been oversubscribed, which is hardly a circumstance indicative of underfunding. The deal terms, too, for the better deals, almost never include warrants. This is not indicative of a market that's undersupplied with capital. It's indicative of a market where probably 85% of the companies don't deserve to be funded at any level. But the juniors that have exhibited good exploration success, that have high quality management teams, have absolutely adequate access to cash.
Now, for the investors, Rick, are we seeing generalist investors, pension funds, people who would normally not invest in gold stocks? Or is it like the larger mining companies like Newmont and Barrick and the royalty companies and yourself that are the ones that are investing into the juniors right now?
I think most of the money is so-called smart money, people who've been in the space for a long time or other mining companies. I am noticing, however, in my conference calls with family offices, which almost always are more specifically focused on oil and gas, an increasing interest in from large family offices in the gold space, including in the gold equity space, which isn't something I've noticed in the last 10 years.
Oh, that's very interesting. I mean, there's currency weakness all over the globe, though. So it's not just the US that's like debasing the currency and monetizing debt. I mean, Japan, European Union, China just announced like some type of QE. So it looks like it's across the board.
When I used to make the case to family offices that I was concerned about the aggregate debt level of on balance sheet and off balance sheet liabilities in the United States and concerned about the deficit, I was met with a fair bit of eye rolling. These were people who had made large fortunes betting on America, people who had been trained in times like 2008 to buy the dips. When I make those same comments today, uh, there's much more apt attention. I don't know what the number is that scares people, but when I talk to folks about $35 trillion dollars in on balance sheet liabilities and $100 trillion in off balance sheet liabilities, and I talk about the inevitability of funding that by inflating away the net present value of it, I think by now the arithmetic is so compelling that it establishes its own narrative, and I suspect that that continues.
We're almost up to 36 trillion already, Rick. That one extra trillion is coming at a faster and faster pace now. I think in the last month, another 500 billion alone was spent by DC. That really shocked people how quickly they could just spend another 500 billion. I don't even know what it was spent on. Student loan debt balance, I'm not even sure.
And that number itself is dwarfed by the net present rather than the nominal value of off balance sheet liabilities, Medicare, Medicaid, Social Security, military pensions, federal employee pensions. That number is estimated by the government itself, not by me, to exceed $100 trillion and is estimated unofficially to be growing between $2 and $4 trillion a year. To put that in uh, reference, net federal income, total income to the federal government from all sources is just more than $4 trillion. By some estimates, the net present value of off balance sheet obligations of the federal government increases by their total income annually.
And I have the base case for the budget deficits now, and I think it'll only get worse no matter who's in the White House next year. I base case around $3 trillion a year budget deficits. I mean, it's getting really, really bad, Rick. It's so obvious now that those family office people that you're speaking to, they really can't ignore it.
No, I absolutely concur with that, Jason. You're not old enough to remember the decade of the 70s,
Yeah,
but we faced
I wasn't born yet. Early 80s. I was
correct.
my early 80s baby.
We faced this circumstance before, admittedly with debt as a lower part of GDP. But we came off the war in Vietnam, which of course we lost, and the war on poverty, which of course we lost. And coming in the decade of the 1970s, the sort of US dollar hegemony was challenged. And the way that we dealt with that is that by the government's own estimate, we devalued the purchasing power of the US dollar through inflation by 75% in 10 years. When you explain to sophisticated investors, probably particularly sophisticated investors of my age that remember that, you get their attention. And I think that's what's happening with the family office. I think they say, what happens if Rick's wrong? And we only inflate away half of the purchasing power of the US dollar.
Well, I think the major issue now is that the foreign central banks, so like China and Japan, they're not large net buyers of treasuries anymore, whereas over the last couple decades, they were large net buyers. So now, like a lot of the major players who used to accumulate treasuries, what with their trade surpluses and foreign exchange reserves, they're net sellers. And it's looking like, well, either the large banks in the US, the commercial banks, are going to have to buy the treasury debt, or the Federal Reserve Bank is going to have to monetize it.
And I think if they step into door two, monetizing it, quantitative easing, which, if we were to name it by its true name, is counterfeiting. If we resorted to that again, then I suspect that you would see the gold market take off in earnest.
Now, I want to ask you about building a new mine. So, Argonaut Gold and Mangino, they had one or two other mines that were smaller. They tried to build a larger mine. Are we at a gold price now where, say, if you're a smaller producer, you can say gold price is at above 2,500, well above, we can easily go out and raise hundreds of millions of dollars of capital and go and build a mine? Or do you think we're not there yet?
The mine has to be robust enough to handle debt financing costs for 60 or 70% of the mine construction that run all in about 15%. Companies that aren't investment grade credits, companies that can't borrow on balance sheet at prime, that are forced into the project finance sphere, are really normally paying 15 or so percent all in. It may not be in simple interest. There may be upfront fees or original issue discounts. There may be kickers in the form of, gold price participation or something like that. But the truth is that a company that isn't investment grade, like most of the junior developers out there, are forced to pay fairly high, fairly stiff interest charges. So the mine has to be reasonably robust. When somebody is able to assemble a financial package, and when I say a package today, very often, in addition to project debt, companies will sell a stream or some other form of offtake participation to secure quasi-equity. But as I say, the mines need to be reasonably robust to secure financing today.
So it sounds like it's kind of smarter then to have a larger, a medium-sized or senior mining company as a joint venture partner, because then they have that revolving credit facility or cheaper cost of capital than in the case of what Osisko Mining and Goldfields or some of these other joint venture deals.
Certainly to the extent that companies are able and willing to drop themselves down to a non-operated carried working interest, their cost of capital is lower. Ironically, despite the fact that the cost of capital is lower, their shareholders often object to this because the shareholders own them for leverage to the gold price. So in this circumstance, financial prudence gets penalized in the market.
But as we both know, I think there's like a Canadian investment bank study on this going back many, many decades. I mean, how often do mines come in on time and on budget? And if you're a one asset or two asset producer and you've bet pretty much the entire company on this one mine coming in on time and on budget, what happens when it doesn't?
Very, very, very true. As you suggest, the industry's record for on time, on budget is checkered. It's interesting, too, that most investors or speculators in the space don't differentiate very well between management teams who have the ability to bring mines in on time, on budget. I'm thinking as an example of the Gignac family, which built Lundin's Fruta del Norte mine, a very challenging mine, on time, on budget, and have recently completed their own Tocantino mine in Brazil on time, on budget. The market doesn't yet seem to value demonstrated experience as well as I suggest that they might over time.
Okay, which mining company owns that mine in Brazil that you said the market hasn't figured out that it's coming in on time and on budget?
G Mining themselves, they built one for their own account.
Okay, it's not publicly traded, it's a private miner.
No, it's public. Symbol
Okay.
GIGMIN.
Okay, that's an interesting one for our listeners out there. So this management team has a track record of building mines on time and on budget. I think the track record, though, for the entire industry, it was a large big data study by Canadian Investment Bank going back, I think, like 3 or 4 decades. I think like 90% of the
Oh,
mines were not on time and on budget. It was a really, really high percentage.
it's horrible. And the number of mines which came in double budget is also scary. I don't mean over budget, I mean double budget.
So you
Mines
mean
that,
like they projected $1 billion and it was 2 billion or something like that?
correct,
And that
correct. I
would
mean,
destroy
the recent experience of Cote Lake was one where the mine came in double budget.
And for our listeners out there, that destroys the capital structure and the balance sheet of the miner. So basically, then the miner's looking at all bad options. Do they add more debt? Do they do equity dilution? Do they do a reverse stock split? No good options there for the shareholder.
Do they sell off other assets, which is what had to happen at Cote Lake? Yep. No, it's not. It's not pretty.
Yeah, and there's some companies that have a history of doing this like every couple of years that have survived. The miner doesn't go bankrupt. The miner has done reverse stock split and share dilution to buy a new mine, overpay for it, and then bring it in not on time and not on budget.
Correct.
It's just a sad state of the industry. That's why, as you know, Rick, with royalty and streaming companies, I mean, those companies, like their profit margins are protected. Maybe they have to restructure a large stream here or there, like Royal Gold with Mount Milligan. Franco Nevada took a ding, but if you bought Franco Nevada shares at $110, I mean, you're sitting pretty well right now, 6 months later.
Uh, Provided that the royalty and streaming company don't overpay, that's a superb business, particularly to the extent that, like Franco or Wheaton, they're able to buy royalties or streams on very large projects. It has been my experience that very large projects almost always yield exploration surprises, and that those surprises are almost always good. So I absolutely concur with you in terms of capturing at least market beta in the royalty and streaming space.
Well, especially if one of those companies goes on sale, because I mean, like there was just insane amounts of negativity about Franco Nevada for so many months. The shares were just stuck around $110 a share because people were panicking over Cobre Panama. I mean, most of the rest of the business was fine. People were like, oh, it's no growth. We don't trust the management team anymore. And it's like, well, they have all these other investments and they started doing more deals. So like, it's not like the company was going to go bankrupt, Rick. It was still a sound company. They just had one bad deal, and now like the shares are starting to recover.
To give you an arithmetic confirmation of what you just said, Cobre Panama represented between 14 and 16% of the net asset value of Franco Nevada. When the asset was forced to be written down, Franco Nevada lost 40% of its share price. 40% decline for excising, say, 15% of NAV. And by the way, the jury isn't out on Cobre Panama. There may be a recovery, but the overreaction of the market relative to the arithmetic in the transaction was excessive. And for me, it was delightful.
Exactly. And the same thing happened, I think, like 7 or 8 years ago with Royal Gold and the Mount Milligan gold stream. So that thing was restructured. I think for a few months, the shares crashed about 30-40%. There was a huge buying opportunity there, too.
In the case of that, Mount Milligan represented about 40% of Royal Gold's free cash flow. That was a bit more of an extreme hit. Mercifully, Royal Gold's balance sheet was in very good shape, and the Nevada assets continued to perform. A circumstance where the affected asset makes up more than a third of your free cash flow, particularly if you have balance sheet challenges, which Gold didn't have, presents a greater, pardon me, presents a greater threat. If you're Franco Nevada, where, as I say, the company represents something like 15% of your NAV, and a similar amount of your free cash flow, and where you have extraordinary balance sheet flexibility and a good growth pipeline, the reaction was clearly one based on narrative as opposed to based on arithmetic.
Now, with the copper price relatively high and China announcing quantitative easing, it looks like copper is also going to play a role in next generation data centers, electric vehicles. So there could be a new source of demand for copper that could that could cause supply problems in the future. Do you think that there's going to be a lot of potential new tier one or tier two copper mines at a relatively low cost, and there's going to be byproduct streams available for gold, silver, or platinum and palladium?
I think that there's going to be increasing attempts to build copper projects and increasing amounts of byproduct gold production. I don't think the new projects are going to be low cost. Uh, 30 years ago, Jason, the median mine grade worldwide in copper was 1.5%. The median mine grade today is one half of 1%. The unit costs for mining copper, perhaps not on a tons mined and milled basis, but on a unit of production basis, are going to be higher than people think they're going to be. The co-product credits for gold will be an increasingly important part of the mine economics. What I think you're going to see, Jason, and I'm making this up, I don't know it to be true, is with the rapidly rising front end cost to develop a copper mine, and with the disparate way the market views cash flow from gold and copper, which is to say, gold cash flow seemingly valued at 15 times cash flow, and copper cash flow seemingly valued at 5 or 6 times cash flow. What I think you're going to see is more and more of the co-product credits, the gold and silver revenue stream, monetized by way of streaming contracts to provide some of the front end capital for mine development. It makes perfect sense where you take cash flow from a large stream and enjoy the Wheaton multiple of 15 times cash flow. And you use the capitalized value of that to lower your equity cost to develop a copper mine when that same cash flow, were it in a copper wrapping, would generate 5 or 6 times cash flow. This is clearly a circumstance where both parties benefit in large measure, and that's what I think you're going to see.
Especially if a lot of the regular Wall Street banks in New York City won't fund a lot of copper mines, because I know they're pro ESG and they're starting to open up to nuclear power, but they just don't seem very interested, at least for now, in funding a lot of mining projects, especially copper mines or gold or silver mines yet.
The Basel III banking accords prohibit, in many cases, the chartered banks, functionally, from participating in financing for non-investment grade projects. In other words, doing the project financing that 20 years ago was the province of, Bank of Montreal, Deutsche Bank, Barclays. The Basel III banking accords, with regards to how banks had to reserve for and account for the asset side of their balance sheet, really precludes them in most cases from doing project finance. The only kind of mine finance they can do is investment grade on balance sheet non-project finance.
Oh, that's really interesting. So basically, then that's given that rule change with Basel has given the opportunity for Franco Nevada, Wheaton Precious Metals, Royal Gold, and some of the mid-tier royalty and streaming companies to take advantage of that. Then it sounds like.
Yes, and the non-bank financials, the Orions of the world, the Sprots of the world, frankly, all the way down to the Rick Rules of the world. There is no way in the world where I could have competed in doing project finance with the Royal Bank of Canada 20 years from now, or 20 years ago, pardon me. Now the Royal Bank of Canada, as a consequence of Basel III, can't compete with me in non-investment grade projects.
So, in terms of new gold mines that are copper and gold mines that are under construction, Greenstone's one of the better ones. Are there any other good copper and gold mines that are fairly low cost, pretty high grade that you think are going to be coming online next year or two?
No visibility for the next year or two. There are um, there are a reasonable number. I don't regard them as low cost that could come into production if the market was convinced that interest rates wouldn't rise a lot and that the copper price would hold above $4. The difficulty is the grade. The median grade worldwide is usually less than 0.5%. And that precludes really low all-in sustaining costs. The reason, I think, why there is copper gold exploration in British Columbia, as an example, is the predilection for BC porphyries to be relatively higher in gold relative to porphyries in other jurisdictions of the world, which is making the hunt for porphyries in BC, which is, I would argue, politically a fairly risky jurisdiction, more popular than it otherwise would be.
Well, you also have like the Saudi Arabia copper Chile, and I mean, their Codelco, their production is trending downward permanently, and the Chilean government is either anti-mining or talking about raising royalty taxes again every time the copper price rallies.
Certainly, the Chilean government has gutted Codelco, stripping the free cash flow out of Codelco very much the way the Mexican government stripped the free cash flow out of Pemex to fund politically expedient domestic social spending programs. There needs to be a major reinvestment cycle in Codelco, not merely, pardon me, on greenfields opportunities, which they have in abundance, but also to reestablish the sustaining capital expenditures at their existing projects. Codelco has a fine range of assets and a great group of people. It's been used as a cash cow by the Chilean government for a very long time. And the Chilean government now needs to allow Codelco to reinvest a greater portion of their cash flow to maintain production and hence maintain that cash flow. They really, truly have attempted to eat the goose that laid the golden eggs.
So you're saying then that the reason that copper production and silver production in large producing countries, say Chile, Mexico, Peru, it's not necessarily because of geology or the mining companies, is a political problem then mostly.
Yeah, I would argue that there's been systemic underinvestment in copper exploration development for 20 years. And let me give you an example of the timeframes. There's a wonderful deposit here in the United States in Arizona called Resolution that was discovered 3 decades ago. That over 1 billion tons of rock at a reserve grade of almost 1.5% copper, 3 times the average mine grade worldwide. That mine has been struck in permitting for 26 years. 26 years. If you take the net present value of that deposit when they went into the permitting phase, in other words, when it was technically able to be produced, and you discount that cash flow at, say, 8%, the entire net present value of the deposit 26 years ago has been consumed in the permitting process. And we're seeing these delays worldwide. That may very well be one of the reasons why we have had this dearth of exploration finance in copper. It may be very well that companies are saying, why should we explore for copper when once we find it, we can't put it in production? That wouldn't be an entirely illogical conclusion.
Yeah, I mean, you have environmental protesters and governments that are I don't know if they're fully anti-mining, but at least like they want to make it more expensive and delay the permitting process out longer. Like in Peru, Peru is what the Corani deposit from Bear Creek. That's a massive base metal mine with silver byproduct. A lot of it, I think, super high grade silver too. And then the Santa Ana mine in Peru, that Bear Creek also, and that thing was totally blocked. So there are potentially good deposits. I mean, it's just it seems like a lot of them are not never going to go into production, or they've been delayed over a decade.
I would argue that those two deposits are more medium grade, and I would also argue that the capital cost to put them in production means that off-balance sheet project financing would likely be difficult to obtain under any circumstances. Were those deposits controlled by major mining companies, and were they be able to, would if they were able to be financed with an investment grade counterparty, they would be very, very different circumstances. But there's plenty of examples around the world that go exactly to what you suggest. It's also worthy to note, Jason, and we talked about this earlier in the interview, that in addition to the fact that commodity prices like gold prices are going up, the input costs to produce them have also been going up. That trend has been more moderated in the last year than it was 2 or 3 years ago, when in particular the energy costs were skyrocketing. But the cost that hasn't been moderated has been the social cost, rents, royalties, and off-concession investments by mining companies in things like water, schools, infrastructure, stuff like that. That number, according to major mining companies, is escalating at about 20% compounded per annum. If you add the increased social cost inputs with the increases in interest rates that we've seen over the last year, what you see is that the financial hurdle established to build a mine has been increasing fairly substantially, even as the product prices have been increasing.
And then add in falling ore grades too, which is especially with silver and copper. So those two metals, Rick, more than even gold. I mean, the gold ore grades have collapsed over the last couple of decades. We're average around 1 gram per ton for a lot of these open pit heap leaching operations for copper and gold mines. But I mean, it seems, Rick, that the silver grades are falling even faster than the gold grades.
Yeah, and there's not a lot of comps, meaning most of the silver in the world that's produced is produced as a byproduct of other materials. Uh, a real silver mine is a fairly rare beast. What's interesting to me in the silver space is the relative success that some companies have enjoyed in silver exploration in the last 3 years in discovering high grade deposits. I'm not sure how they did it, but I look at what Aya Silver was able to do in Morocco as an example. What Abra Silver appears to have done at Diablios. Particularly embarrassing to me since we owned that in Silver Standard and didn't find it ourselves. And also what Vizsla Silver has been able to do in Mexico. The industry really, without spending in historical terms very much in terms of exploration, has done a pretty good job in those three cases of finding primary silver deposits that I think will rank very well. Of course, earlier on, there were a couple of exploration successes. I'm thinking Gatos and Silvercrest, where although the grade was in shape, it appears that both of those deposits were rushed into production, and the reserve and resource size estimates turned out to be, at least so far, not sustainable. But I'm impressed with the exploration results at each of Aya, Vizsla, and Abra. And the market, of course, has rewarded all three of those names extravagantly this year.
Now, do you think those are going to be low cost silver projects? Or are they going to be economic at $20, $25 an ounce silver? Or are we going to need much higher price floors for silver, say $30, $35, maybe even $40 an ounce silver to bring new silver supply online in the next 5 to 10 years?
If you give me today's interest rate, these things are economic at $25 silver. If you double the interest rate, that gets challenging.
Okay, so they sound fairly low cost compared to some of the other, because I knew in the 2011 cycle what Silver Standard, because you brought it up, it's not Silver Standard anymore, it's SSR. They discovered what the Pizzeria deposit in Mexico, but that's like very high cost. I mean, I think like a decade ago, they needed $35 an ounce silver for that deposit.
Yeah, that was partially a function of what the byproduct zinc credits would be. It wasn't really a pure silver deposit. In the case of the three I mentioned, Aya, Wisla, and Abra, they really are silver dominant deposits. Uh, I don't know in any of the three cases what the upgrade feasibilities will look like. I just know based on preliminary economic assessments that at today's interest rates, it's likely that all three of them work. Of course, at Aya, they do have one deposit in production now, and it's performing admirably.
So now I want to transition to uranium, and you've been a uranium bull for a long time. Finally, a lot of people are starting to wake up to nuclear power. Do you think with the investments from big tech, so Amazon and Google and Microsoft making these investments, co-investing, I guess, with the electrical utility companies. Microsoft just announced a large deal with Constellation Energy to reopen Three Mile Island. And then there's additional expansion plans, I think, at existing nuclear power plants. Do you think that there's a new paradigm shift coming now that big tech is co-investing with the regular utility companies for nuclear power?
I do. I think the paradigm is more important in the near term than the arithmetic, meaning that the big investments in front of us by technology in data centers and associated power plants will impact demand for uranium 7 years out, 8 years out, 10 years out. Three Mile Island may be an exception. I don't know what the re-permitting of that is going to look like. But what it's done is given a whole new generation of investors permission to invest in uranium. What's much more important in reality to the uranium market is the deferral of existing plant shutdowns and the resumption of hot stopped production, particularly in Japan. That impacts demand now. And secondarily, the incredible pace of new plant construction in China. The other variable, which people don't look at because it's complex, it's not emotional, is the emergence of a term market in uranium. Uranium being the only commodity on the planet that I know of where producers and consumers can enter into a contract specifying prices and volumes for 5 years, 10 years, 15 years, 20 years. And that means that miners can have some real sense of at least what their top line looks like. In every other commodity, you're constrained by an overnight market, a spot market. But in uranium, you can lock in prices and volumes for 2 decades.
And
And the fact that a whole bunch of people are trying to finance reactors right now, and the fact that very often the debt providers for those plants are requiring the plant builders, plant owners, to contract for enough uranium to amortize the bank loans means that even junior uranium companies with non-investment grade balance sheets will be able to take signed investment grade counterparty contracts to the bank and use those as collateral. That's a very different circumstance than was present in the uranium market 3 years ago or is present in any other commodity market that I'm aware of on the planet.
Rick, also from me speaking with like Justin Unu, Uranium Insider, and some other people, it also sounds like the existing nuclear power plants in the US, they have expansion permits in hand, so they can add additional nuclear power reactor cones. They can expand. They just didn't do it because there wasn't the demand for it. But now if big tech, if you have Microsoft and Amazon and these big tech companies, Rick, I don't know if you've seen any of the capital expenditure projections, but it seems like each quarter now, they're spending tens of billions of dollars of capital expenditure in artificial intelligence and data centers. They are fully committed to this. Amazon has said they want to spend 150 billion of capex over the next 5 years. They're buying land like crazy here in Northern Virginia. There's a land grab in Georgia, in the Atlanta area around that new nuclear power plant that just came online. They're all trying to build data centers around it. So, I mean, this is a really exciting time right now for the electrical utilities and the nuclear power and data center companies.
It is. I would just point out that in terms of making a difference in terms of uranium demand, you're many years out.
Okay,
And people who are speculating on uranium based on that need to have a very long-term time frame. Many uranium speculators base their actions on 5 or 7 year narratives, but they employ tactics that give them trauma over a long weekend. I'm not dismissing any of what you say in terms of the demand that will ultimately be generated by data centers and AI. What I'm trying to say is that if you're a speculator on that, if you're a speculator on the proliferation, as an example, of SMR technology, that you have to have a very long-term outlook, an outlook much more similar to mine than the outlook employed by most uranium speculators.
Yeah,
One other piece of great work that Justin has done that everybody should pay attention to is the reloading schedule. The fact that many utilities have deferred purchases of fuel for reloading and are really going to have to engage in that, and they're going to have to engage in it at the same time that there's a shortage, a projected shortage, not a current shortage, of Russian enrichment capacity, which means that the utilities are going to have to overfeed going into this next fueling cycle. And Justin's done some great work on that, and although it's an obscure fact, it's a very important fact.
Okay, so what you're saying then, if I could summarize it for our listeners, is that even if, let's say, that new nuclear power plant in the Atlanta area, even if they have expansion permits to build additional reactors around the existing ones, that's going to take years, even if they started construction tomorrow then.
Correct.
Okay,
Correct.
so unless you're Microsoft or Google, right, and you have all these lobbyists, and then maybe you can fast track some of the permitting process, but just to build the thing, it's going to take at least a couple years then.
Well, remember that you're talking about a marginal fuel consumption in that plant of 150,000 pounds in a 130 million pound market.
Well, it sounds like there's a lot of opportunities there for the data center building companies too. I mean, they're going to commit the capital. Yes, not short-term trade though, for sure.
Correct. Correct.
Although the risk reward for uranium, Rick, a couple years ago, 3-4 years ago, I mean, Cameco between $8 and $15 a share, Kazatomprom that cheap. There was really good risk reward then compared to now. That like Goldman Sachs just keeps raising the price target on Cameco.
I think the upside is smaller, but the probability of realizing the upside with the ability to monetize term contracts, it means that from my viewpoint, absent a global depression, that the certainty around my assumptions is closer to 100% than 50%. And that's important to me. You can take away some of my upside, Jason, if you take away all of my downside. And that's what the term market does. The only fly in the ointment would be, of course, an event like Fukushima or 3 Mile Island.
Yeah, that's always the risk. But I mean, like, how else are these data centers going to have cheap, reliable baseload electricity? It's not going to be from wind or solar, not consistently, anyways.
And they've already said it isn't going to be cheap. What Microsoft has talked about at 3 Mile Island is a levelized power cost that's roughly twice the grid rate. But they get it uninterruptible and they get it without carbon. The one of the flies in the ointment here in favor of uranium is the instability of the U.S. grid. There are estimates that it would take up to $8 trillion to upgrade our grid to the extent that it ought to be upgraded. And anybody who requires completely reliable 24/7 power, particularly if they want it to be non-carbon generating, that completely addressable power is something that the big data centers are willing to pay a huge premium for.
The cheapest power, Rick, is actually natural gas, but then there's not enough natural gas pipelines to move the natural gas, say, from the Marcellus and Utica shale in West Virginia and Pennsylvania down here to Northern Virginia in the DC metro area. So they still have to build those pipelines out. And then you have politicians and bureaucrats and environmentalist lawyers all trying to block the pipelines.
And despite the fact that natural gas generates 75% less carbon, it still generates carbon. And you still have opposition to natural gas for that reason. Obviously not from me, Jason.
Well, I mean, that's the thing with energy. There's no perfect form of energy. All forms of energy have issues. I think the average person doesn't understand that. Unfortunately, I think there's a lot of adults out there that think that electricity just comes from the socket. They don't understand how difficult all forms of electricity and energy are.
Quite true. Quite true.
Yeah, because I mean, we're not doing perfect fusion. We're nowhere near that. It's just like a pipe dream. It's like a cheap science, well, very expensive science experiment at this point.
Right.
So, I want to ask you about risk and reward. What's cheap? What's hated? Uranium was very cheap 3 or 4 years ago. Do you see any commodity out there, platinum and palladium, natural gas, that has similar risk reward, cheap and hated characteristics to uranium from 3 or 4 years ago?
Yeah, North American natural gas, particularly Canadian. The risks are real. The Prime Minister of Canada doesn't like the natural gas industry. That's political risk on top. If the Canadians were to thank and excuse him, I think that you would see an overnight doubling of the gas-centric Canadian names. But I think the increasing investment in Canadian gas transmission and liquefaction facilities on the Pacific coast will alleviate a lot of the bottleneck anyway over the next 5 years. The arbitrage, Jason, is unbelievable. Canadian natural gas at AECO, the Alberta Gate, is about $1.50 Canadian per million British thermal units. That same gas delivered in Shanghai or Tokyo or Rotterdam is worth about $10 Canadian per million British thermal units. And it takes about $2.50 Canadian to get it there. These
And you have the new
margins.
pipeline. So that's in Alberta, right? And the new pipeline just came online.
Yep. Yep. So, I would suggest that North American natural gas generally, but Canadian natural gas in particular, if you have a 2 to 5 year timeline, offers at least as good risk to reward as the uranium trade did in 2021. Other commodities that are hated include sulfide nickel. It's going to stay soft for a couple of years as a consequence of Indonesian lateritic nickels. Rare earths, in conjunction with the decreasing prices offered by the Chinese, are very hated. And I think that that's a price that's due to rebound. That's probably all we need. I guess the most dramatic one, likely over the next year and a half, will be lithium. Lithium was the flavor of the month for a very long time. We spent millions of dollars looking for it because we'd never looked for it before. We found a lot. We were never short of elemental lithium. We were short of processing facilities to turn elemental lithium into lithium chemicals. In the last 5, 6, 7 years, we've eliminated those processing bottlenecks. And after having witnessed a 500 or 600% increase in the lithium price, we've now seen a 75% decrease. Lithium demand will continue unaltered, but probably only 7 to 10 of the deposits discovered in the last 10 years. There's probably 100 deposits. Only 7 to 10 will go into production. And I think even perhaps despite Rio Tinto's takeover last week of a junior lithium company, that the general trend for lithium equities for the next year and a half is going to be lower. And I suspect that the hate that the lithium companies encounter will be similar to the hate that was encountered by the silver juniors and by the uranium juniors. And I look forward to that. I'll stock up on them when that happens.
Yeah, if the lithium price stayed high enough, I mean, they can take lithium out of the frack water for hydraulic fracturing, but it's very, very expensive. So, I mean, they have found a lot of new lithium supply.
That's the huge risk. The huge risk is direct lithium extraction from produced brines in oil and gas and produced brines in geothermal. There's no limit to the amount of lithium that we could produce just in the United States from hot brines. If that technology proves efficacious, and by the way, Exxon thinks it will be, that could be a real game changer.
That's very interesting. That's something for our listeners to watch for updates on that in the tech sector being applied to energy. I mean, the energy industry actually uses a lot of technology. It's just not given credit for it with the exploration geology, big data, artificial intelligence. They're using a lot of new types of technology over the last couple of decades.
The cost for foot of penetration in the U.S. in drilling, uh, well, the cost have declined in real terms over 20 years, threefold. The advancements in technologies that we've seen in horizontal drilling and three-dimensional seismic, measurement while drilling, fracturing, has taken the most over-drilled province in the world, which is to say the United States, and doubled its production in 10 years. It's just astonishing.
And you have the octopus drilling pads. They've gone further out on the laterals. They've become more efficient at drilling the wells, but that just pulls the oil and the natural gas out of the ground faster, though.
Correct. But it does mean that oil and gas that we couldn't economically access 20 years ago, we can get now.
So I want to ask you about platinum and palladium miners. Do you think we're going to see a lot of bankruptcies here with the South African platinum and palladium miners? Because it looks like they're not going to be able to cut their costs. I'm not. We're not seeing even with BHP Billiton. They didn't want the when they were going to do a deal and buy the copper miner. They didn't want the platinum and palladium assets. I think they got spun out. And then the car sales for a lot of these car companies. I mean, some of them for electric vehicles, regular cars, they're collapsing.
I haven't seen much evidence of internal combustion engine sales collapse. I have seen increasing sales of electric vehicles, but the corresponding decline in internal combustion engine sales, I think, are in reasonably good shape, simply because the affordability of internal combustion engines in emerging and frontier markets has kept that market intact. With regards to South Africa, what you say is interesting and true. The political and social realities in South Africa are that title and taxation is very uncertain going forward. Given that returns are uncertain, the industry has been unwilling to make capital expenditures, investments, not knowing if they'd recoup their capital. And that means that their labor force doesn't employ enough technology per worker to increase the wages. So they're in this ugly place where the worker wages have to go up, but they can't go up. They're between a rock and a hard place.
Didn't South
I,
Africa also have a similar problem with their gold mining over the last like 10 years too? So that's why their gold production is down so much.
they have, and the same circumstances at play. Uh, an uncertain fiscal and regulatory outlook, the need to make sustaining capital and new project capital investments, and the unwillingness to do that as a consequence of political reality, which means that the labor costs are far too high, even while the workers don't make any money. It's a really, truly ugly scene. Now, there are certain platinum assets in South Africa. I'm thinking of the Anglo-Plat's open cut deposits that make a shitload of money at this price. They make a lot of money. The difficulty is that the ANC government in South Africa is having a look at that money and would like it for themselves, which is, I think, why BHP took a look at that asset, and despite the fact that it coins money, wanted to see it spun off before they did a transaction on Anglo.
Oh, interesting. So it wasn't economics; it was more geopolitical. Whereas they're worried that there would be a high royalty tax, or the assets could get seized.
Correct. Correct. Or that its labor costs would be ring fenced with the other underground operations.
Yeah, I mean, you have Ivanhoe building the Platreef mine, which is going to be That's going to be mechanized, though, right? It's not going to be as many humans mining. It's going to be a lot of it's going to be mechanized, though.
That's the great experiment. Will the Japanese government and Ivanhoe be allowed to extract the capital that they're putting into it? Because they're putting a whole bunch of front-end capital into it. It will be an extremely efficient mine where the individual workers have to be trained extensively, but where they employ enough capital that they will be making by South African standards a very handsome wage. It'll be interesting if that experiment works as to whether that will make the South African government more willing to allow its mining industry to recoup capital and hence make capital investments.
For our listeners out there, the problem with platinum and palladium supply, the majority of it's either from Russia, South Africa, or Zimbabwe. So those three countries are not exactly stable. There's falling ore grades, rising costs at a lot of those mines. Because some of these platinum and palladium mines, Rick, they've been running for many, many decades. They're very, very old.
Correct. Very long of tooth. I'm myself invested in a couple of platinum exploration plays outside of those countries. I think that the market would pay a premium for an economic deposit that was outside of South Africa, Zimbabwe, and Russia. And so I'm taking the exploration risk in hopes of benefiting from the geopolitics of platinum.
And you also have the safer play there, the Sprott Physical Platinum and Palladium Trust. So Sprott comes up with these good physical trusts. What they have, the Uranium Trust has been very, very successful for Sprott. They've been doing a good job with these the last couple of years.
Well, thank you for that. I was a partial architect of those products, and I'm very proud of them, even despite the fact that I'm no longer employed at Sprott.
Well, didn't they just launch a physical copper one, right? So there's going to be a physical copper. They're going to store the copper in the vault and hope to sell some of it at higher prices. And they just launched, I think, what, copper miner ETFs too?
Yes. Yeah. The Sprott management team is very excited about the whole energy transition sphere. And if you're excited about that, a primary play is copper. It takes copper to generate it, takes copper to transmit it, takes copper to use it. And I was always nervous about a copper trust because the unit price of copper relative to the price to store it and transfer it meant that the management fees, the operating fees, relative to the unit cost of the goods stored were high. If you compare copper at $4 a pound with uranium at $80 a pound, or even $40 a pound at the time we launched, the economics of for the trust, uranium were clearly superior to copper. It's the bet of the Sprott team that the size of that trust grows to the point where the storage costs relative to the price of the material becomes hyper economic for the unit holder, which is what I hope happens.
Are they going to have to store that much physical copper in lots and lots of warehouses? So it's not like a vault that's sizable like for gold or silver. They're going to need giant warehouses if this physical copper trust becomes successful.
What Sprott has learned in the uranium business is that holding product in numerous locations around the world allows you to do location swaps. And while the total amount of material that you have stays consistent, if, as an example, there's a temporary shortage of material in Europe, you can sell the material from your holdings in Europe while at the same time adding material in South America and benefiting from location swaps. The copper market is substantially bigger than the uranium market, so that the opportunity for geographic dislocation, the opportunity for Sprott to do riskless location swaps with the benefit accruing to the unit holders is high.
And is that like arbitrage? So is that like arbitrage where they have copper stored locally, they could sell it at a higher price and they could buy it back at a cheaper price at another location in another country?
Simultaneously, so there's no risk to the trust. In other words, if somebody needs 1 million pounds of copper in Shanghai and you have 1 million pounds, you sell it in Shanghai while simultaneously buying it in Chile or the Congo.
Wow. So you don't have to load it like a liquefied natural gas export facility then, which is like insanely difficult to take that cheap natural gas in the US or Canada and then put it on an LNG tanker at the facility. Very, very expensive, very, very uses enormous amounts of energy and then move it with the tanker to Europe or Asia.
These are simultaneous swaps. So no inventory risk to the unit holder, but sometimes some nice price arbitrage. And as you suggest, for the buyer, no time delay in alleviating their temporary geographical shortage.
Oh, that's really cool. That's something even I didn't know. I guess I learned something really interesting today.
Well, we didn't know it when we set up the trust. It's just something that's happened.
Well, I guess it's beneficial and it's a blessing in disguise that you diversified and then you learn that, oh, we can start applying this to the other trusts then too.
Correct. And I would suspect with the copper market being much larger and much more liquid, that the opportunity to do that in copper will be greater than the opportunity has been in uranium.
Well, also, I'm a Sprott Inc. shareholder too, so that sounds like we're going to be getting more dividend increases going forward from this.
The physical trust business, if you're a Sprott Inc. shareholder, are very good businesses. When I joined Sprott, those physical trusts had about $1.5 billion in assets. Now those trusts have 30 billion in assets. And although our fees are fairly low, the margins that we earn on those fees are spectacular. And what you see in Sprott is a really truly amazing free cash machine. And I would be surprised, frankly, if as the net asset value grows and the free cash flow grows, which it has been for several quarters straight, it is not unlikely, unless there are some really good new product investments to make, that you'll see increased distributions to shareholders.
Well, especially if you get these institutional investors, pension funds, generalist investors that say have $50 billion or more, and they start allocating a couple percent instead of to, let's say, GLD or SLV, it's going to the Sprott Physical Trust instead.
And I would argue that that's a good idea, given the leverage nature of Sprott's return. The margins that Sprott enjoys on those physical trusts are better than the operating margins that any miner other than, say, Franco Nevada could possibly enjoy.
And that's why I've been saying that the Sprott Inc. is a good way to have gold and silver exposure for years because you're not taking any mining risk. So you get exposure to these different commodities. If you, well, you're not working at Sprott anymore, but when you were there, I mean, you guys were coming up with ideas for new commodities trusts or mining stock ETFs. And some of these things have been very, very successful over time.
Well, understand, Jason, I'm still conflicted. I'm still almost a 10% shareholder. Although I'm not an officer director, I am the largest shareholder of Sprott. So anything I say in this recording could be viewed as having a conflict of interest.
Well, that's interesting that Eric Sprott isn't, but I think he's been buying a lot of junior mining stocks lately.
Uh, Eric has a taste for more risk than I, which is probably why he's richer.
Well, Rick, I really enjoyed our discussion today. Now, you have a recordings for a virtual conference that you did last week on Tier 1 assets. So please tell my listeners about that. I'm sure a lot of them would be interested.
Our boot camps are 8-hour long online discussions of various single topics around resources. We've done silver, we've done rare earths, we've done uranium. We did one this week on Tier 1 deposits, those ultra large deposits that are the staple of income and dividend investors and are the great rainbow for exploration speculators. Most of the money that's been made in resources has been made on a very few deposits, and this is a discussion about the economics of investing in Tier 1 deposits, or the economics and the techniques involved in speculating in the exploration for Tier 1 deposits. The information is timeless, which means just because you didn't hear it on Saturday doesn't mean you have missed any of the value of the courses. We also, in the discussion, name 13 exploration stage projects which we believe have the potential to achieve Tier 1 status. This information and the ability to play the recordings of the Tier 1 conversation for a year, and by the way, you'll need that. We'll give you more information in 8 hours than you can absorb in 8 hours, is available for $99. If you go to ruleclassroom.com or ruleinvestmentmedia.com, you can purchase the recordings there. And if you purchase the recordings and if you listen to the recordings, and you don't think for any reason that we've delivered your money's worth, we'll refund your money. Full money back guarantee. We won't ask you why you asked for the money back, but if you did ask for the money back, we would love to know how we failed you. It's worthy to note, Jason, that in 28 years of offering up money back guarantees on educational products, I have had to refund less than 1/10 of 1% of the course fees on offer, but nonetheless, full money back guarantee. I'd also like to offer up, Jason, for free, the ability to go to my website, Rural Investment Media, where I will rank for no charge and no obligation your natural resource investment portfolio. Go to ruralinvestmentmedia.com, list your natural resource stocks. Please no tech, please no crypto, please no pot, natural resource stocks only. And I'll rank them 1 to 10, 1 being best, 10 being worst, and I'll comment on individual issues where I think my comments might have value. That's ruralinvestmentmedia.com.
Sounds very good. And the money back guarantee, I mean, most of the people in the resource industry don't do anything like that. And you do that with your conferences too, which is very impressive.
Full money back guarantee for 28 years, sir.
Now, for tier one deposits, the producing ones, is that like a Canadian Malarctic, a Detour Lake? Those are some of the two of the better ones.
Yeah, my own definition is in excess of $10 billion in situ recoverable reserves and resources, preferably much bigger, with potential annual sales in excess of 750 million US. That is simultaneously in the best cost quartile worldwide for the commodity produced, and simultaneously in the best quartile for return on capital employed, but at any rate, with aggregate returns on capital employed in excess of 25%. These are very, very, very rare. And yes, both Detour and Malarctic qualify.
And Agnico owns both of those. So Agnico's sitting pretty. I guess like that's why the valuation normally is higher than a lot of the other miners.
I think it's one of the reasons why every quarter they seem to meet guidance. You know, these are large, high quality deposits. And what happens with a very large deposit is that although your aggregate return on capital employed may be 25 or 30%, the returns on marginal investments, bigger haul trucks, bigger shovels, process optimization, returns on capital employed around tweaking an existing great deposit can be 100%. They can be fantastic.